Hi, everyone. Welcome back to Mike's Minutes. My name is Mike Dunn, a wealth advisor with IPC Securities. So similar to the last video I posted, I wanted to provide some education on another wealth planning topic, which is tax. Considering that we're approaching year end, I thought it would be a great time to discuss tax and bring in a specialist in that area. So today it's my pleasure to introduce Phil D'Souza, chartered accountant who runs his own accounting and tax practice, specializing in tax planning for individuals, estates, and small businesses. As always, the purpose of these videos is to provide education and not advice, and everyone's situation is different. And we always recommend it is best to reach out to professionals when it comes to these important topics in your life. If you'd like further information, please reach out to me by email at mike.dunn@ipcsecurities.com. And also, if you want to be notified of new content, please subscribe to my channel. So now that my disclaimers are out of the way, Phil, I want to thank you for joining us today and providing us some further education in the exciting world of tax and accounting.
Pleasure to be here, Mike. Thanks for having me.
No problem. So before we get into a couple tax strategies, obviously I don't want to, have a video that's 2 days long with every tax strategy that's out there. But maybe Phil, you can provide us some comments just on the year from your perspective.
Sure. Yeah, it's been a very interesting year this year because of COVID-19. For example, I was expecting the government to really raise taxes in the 2020 budget. A lot of this stuff was put on hold because the economy was in trouble. So it's been very interesting. A lot of people this year have had big changes in their income this year. So, this year especially, tax planning becomes essential. You can't just use what was done last year and think that you're going to get the same benefits. So many people have had decreased income. So you have to look at, does it really make sense to make your RSP contribution this year if your income was lower? So, for example, why would you defer taxes to a year that's higher income? Perhaps it's a good time to, contribute to your TFSA. Perhaps it's a good time to realize some of your accrued capital gains. And that's quite honestly why I like partnering with professionals like yourself, because there's lots of tax synergies when your accountant and investment advisor are working together to create a effective tax plan, really. Something to consider is also, with respect to these COVID-19 programs that the government's had in place, a lot of them haven't had taxes withheld on the payments. So if you receive the CERB or some of the other programs, you might not be expecting a tax bill this year, but you'll actually have them, because typically your income tax is withheld at source, but this year you might actually have a tax bill. So, there's a lot of changes this year. There might be some surprises out there. So another interesting point is people have to use a lot of their personal assets this year. A lot of people have been working from home. So there's things like workspace, cell phones, vehicles. A lot of these things could be deductible since you use them for employment, or, if you ran your own business, they would always be deductible. But now this is now potentially deductible for people who haven't deducted in the past. Now CRA, usually they would require they had a long T2200 form because of COVID and a lot of people work from home. They have actually changed this to a much shorter form to make it easier for your employer to fill this out for you. They've also just recently come out and said you could actually claim up to $400 in these expenses without even having to get the T2200. So everybody really should be, tracking their expenses, all the things that they would be using in their employment, and also requesting the T2200 from their employers. These are some of the, changes this year, which would kind of apply to everyone, I would think.
Yeah. No, those are good points. I mean, being in finance, and there's been a lot of changes. There's going to be a lot of changes, week by week, month to month. All the more reason to work with an accountant. I know a lot of people do their taxes and things like that themselves. And hey, if that's what you want to do, great. But you just proved why at least I work with an accountant, and just less work for us. But those are great points, and I'm sure down the road we'll have more information. This is something that none of us planned. It's not in the rule book. So, even for the government, it's a whole new world. So we're trying to figure it out as we go along. But that's great. So just kind of switching gears more onto the tax side here. Like most financial topics, I mean, there's a million things we could talk about. And we'll definitely do more videos on some tax planning strategies together. But you mentioned RRSPs, and those hit home with me for what I do as an advisor. But I wanted to get your thoughts on them. And I know everybody's situation is different. We're always going to say that. But what do you think about them as a tax strategy for individuals?
Yeah, great question. So the goal of tax planning is really to get your money the most efficient way possible. So RSPs, they're a great tool for effective tax planning. However, like you mentioned, there is no one size fits all. Now, I would say if you're not good at saving for your retirement, then RSPs provides a nice solution for pretty much anyone, because basically you're putting money away and you're deferring tax, and it becomes expensive to take the money out. So it's a great way to just use as a piggy bank. But there are more advantages if you decide to kind of structure it as a broader tax plan in order to plan it out for the next 5 years, 10 years, 20 years, because quite honestly, sometimes it doesn't make sense to make an RSP contribution. It may be best sometimes to withdraw from your RSP or make a spousal contribution. So I would say one very common scenario is a retired pensioner who is set to start receiving pension income, CPP, OAS when they turn 65. Should they use an RSP at the age of 60 to defer taxes? It's probably worth looking at, but probably not, because their income is probably going to be lower at 60 than it will be when they turn 65. So they should actually consider maybe withdrawing from their RSP, maybe even at age 60, to lower their automatic withdrawals at 71, or even not have that much of a OAS clawback when they start getting their pension income. Another scenario would be, if you knew next year you're going to have significant income. For example, you sold a secondary property, or you sold your business, or whatever you might have. Perhaps you don't make a contribution this year and save your RSP room for a year where you have the higher income in order to really maximize the benefit. So, there are many different tools for effective tax planning. And I would say it just really becomes valuable to sit down with someone every year in order to decide the best path. It could really save you, thousands of dollars a year, which, as you know, if you put that money and you invest it in stuff, it could be kind of life-changing in terms of your retirement planning.
Yeah, for sure. I mean, one thing that I really gather from what you just said, and it's what I preach as a wealth advisor. We're not necessarily transactional. Yes, investing money is part of what I do, but it's also planning. And, for younger clients, is to look at where they are now and then get a sense of where they want to be. And the whole way we factor in tax. And, like most things in life, when you have time and you have that long-term planning, it makes things a lot easier, and you don't kind of get stymied at the end where you've kind of backed yourself into a corner where you've made one decision the whole time with not looking down the road, right? Like, a simple example, younger clients, I hear a lot where they're putting all of their money in their house, and they're not, focusing on long-term savings. And they're saying, I want to use my house as my retirement savings. Well, that's making a decision today that, really is not going to be effective until 30 years down the road. But with no planning, they've made one decision today and they have one option down the road, instead of kind of, planning many different ways to do it. But, great points. We'll definitely have to do another video just on RRSPs. I think there's a lot of value add there. Business owners, individuals, tons of information. But I also wanted to ask you one last topic here. Many individuals, marriage, common law relationships, they have the ability to income split. And this is something that I hear a lot of. So maybe you can give us your thoughts on income splitting.
Yeah, another great question. So yeah, income splitting, just like RSPs, it's a great planning tool, right? So you can again save a lot of save a lot of money if you're able to move income from the high income earner to the lower one. Now, in 2017, CRA did put together a package of significant tax changes, and not all the proposed changes went through, but one of them that did go through was the tax on split income. It really reduced the abilities of families to split income using trusts, partnerships, corporations. It didn't eliminate the possibility completely. There are exceptions, which include, if the spouse or child is active in the corporation or partnership, you could still split with them, but it really did limit your ability to split income from that perspective. There is still the possibility, like you could use a family trust to split income, but there's more restrictions on using it, and it has to be structured in a very specific way. Again, it's important to work with professionals that they kind of know the ins and outs of the tax code in order to structure it well, because CRA is attacking these structures, and they are auditing them and making sure that all the T's are crossed and I's are dotted. So it's still a possibility with family trust, but you have to make sure you're doing it in the proper way. Mm-hmm. The other income splitting opportunities, which are easier to put in place, there's always the pension splitting. When people reach the age of 65, they can split their pension income, not CPP, but the other pension incomes with their spouse, which really reduces the family's tax bill, which is a great option. Another one which we touched on again a little earlier was there's the spousal RSP. So what you would do is, instead of contributing to your own RSP, you would contribute to your spouse's income, and then eventually when the money comes out of the RSP, it gets taxed in the hands of the spouse. Yeah. So you could kind of use that to move income to the lower income person as well. Yeah. So there are options available. But again, you just really need to figure out a plan which works best for you and your family, and kind of figure out your goals. And they always change, which it's important to sit down and figure out where you're at and where you want to be, and kind of use the tools that are available to you to make tax as efficient as possible. Yeah.
Yeah. It's essentially kind of evening the, one tax bill to the other, right? Like it basically, from the high income earner, bringing some money to the lower income earner to kind of bring them up. They might pay more tax, but the higher income earner pays less tax. So, good points, very, specific to everybody's situation. I mean, I deal with spousal RSPs, and, one thing that I really like is when I work with a client is to talk to their accountant, to be up to date on what he or she is doing on their tax side. And really to be successful financially, I truly believe you have a little team behind you. You have a good accountant, a good advisor, and if you need a good lawyer, have a good lawyer there. Listening to you, I mean, on the tax side, like, I know a lot about tax and how it applies to personal finance, but for me to become a tax expert plus an expert in what I do, I mean, that's a lot of information. I can't even imagine somebody that has no knowledge of both trying to figure it all out. Like, that would be a very difficult task. So, I want to thank you again for coming out. I mean, we could sit here all day and talk about tax strategies. So we'll definitely have to do, more videos together. But thanks again, Phil. Great information. If you have questions for either of us, please email me at mike.dunn@ipcsecurities.com. And this wraps up another video here on Mike's Minutes. So as always, thank you for tuning into us today. Again, these are for educational purposes. I hope you learned something. And until next video, stay safe, stay healthy, and stay invested. Take care.
Thanks, Mike. Pleasure being here.
Thanks, Phil.